was supposed to be on. This works. Fantastic. Look at that. We are, we are making progress, people. Happy Friday freaking night. We are making things happen, doing stuff, all the things and whatnot. You know, just let me get this thing up on here. Drop the link. Ooh, we don't want that. Shut your mouth. All right. Sorry about that, peeps. We're just getting set up here. Figuring out some new stuff tonight, some new technologicals. Super excited. Got my guides set up and ready to go. So if you want access to some DSCR basics, you can DM me on Instagram guide, and you can get access to that. But tonight we're going to be talking about some DSCR. I didn't get to do that yesterday because of my not great time management. Plus, I forgot about the I-81 meetup, so I was out there pretty late. But yeah, well, I guess it wasn't out there too late. I think I left at about 8:30ish. Had a 45-minute drive back, ate dinner, and then I had to go for my 45-minute walk. 75 hard, and we are on day 6. It's been going well. We're going strong. A lot of fun. So cool. Super grateful for some of the support that I have been seeing from people online and off. Very interesting. The other day, I found out that some of my friends had been watching my stuff, and I didn't even know it, which is great. So I'm always super happy, super grateful to find out that more people are actually supporting me. So that's awesome. If you are on Instagram, you can comment the word YouTube, and if I did this correctly, it should send you a link to come over to YouTube, where you can hop in, interact, ask questions in the comments. If you are on Facebook, I have dropped the link in the comments. Will not be hopping over there to check too often, check for questions and whatnot. So we'll give it just a few more minutes here, see if anybody else hops in. And then we'll get rolling. Talk about some things that I am working on. I actually need to look at a deal here in Hagerstown. I am not in Hagerstown, but it is in Hagerstown. And see what's going on with that. I didn't have a chance to look at it, but I sent it out to some friends, and I'm really hoping it works out and we can actually do a group flip, because that is what one of our meetup groups is working on. It's going to be a pretty cool project, so I am super excited for that. And then, of course, I've got another client that I'm working on getting in touch with. Shout out to Brian DeMuro, awesome guy, wholesaling, I believe, out in Harrisburg. Just super great guy all around. Him and Marcelo have been, graciously helping me on my journey. And so they actually connected me with someone who is pretty local to where I am. So I'm looking forward to, getting in touch with him more and meeting him in person at some of our meetups. But yeah, I am absolutely looking forward to that. But tonight we are going to talk about some non-QM stuff because I didn't get to do that yesterday. So for those of you who might be watching in the future, you may not know I am a mortgage broker. My name, wrong one. Yep, we'll get this one day. My name is Chris, mortgage broker over in PA. I am focusing on non-QM loans. That means non-qualified mortgage. So what a qualified mortgage is just a mortgage that falls within Fannie Mae and Freddie Mac's guidelines. So think like FHA or like a basic conventional loan, typically like a homestead buyer loan, you know. Non-QM, non-qualified mortgages fall outside of those ranges. And so the cool thing with that is these are loans that are going to be made for investors, self-employed borrowers, people who have varying income. And so it just gives them a lot more ways to qualify. So being a broker, I have over 30 different lenders at our shop. And we can do hard money, DSCR, bank statements, P&L. If you have a problem, bring it to me. We will find a freaking solution. And if we can't, we'll get you pointed in the right direction. So my focus is predominantly non-QM, DSCR. I'm looking into more bank statements and hopefully going to be able to apply those to some situations soon. Also diving into some closed-end seconds and looking for more ways to apply those because I believe they'll be able to kind of fill the role of a HELOC. But don't quote me on that because I'm still looking into it. With that being said, let's talk about some DSCR, debt service coverage ratio loans. These are going to be great loans specifically for investing because they're going to qualify based on the property's income and not your income. So when they're looking at that, you know, typically if you're looking at a long-term rental, they're going to look at your PITI, your principal, interest, taxes, insurance, and any homeowners association dues, you know, your typical mortgage payment. And then you're going to take your property income and you're going to divide it by that PITI number. What that's going to do is it's going to give you a ratio. So if I pull over my handy dandy wheat board, I'm going to take a picture of everything on there so I don't forget. Cool. Cool. Let's just pull this over real quick. And we got some debt service coverage ratio. Now, hopefully this isn't backwards, because if it is, I will not know how to flip it. I think it might be backwards. Let's see. Is there a way that I can change the camera angle? Is that? No, now that's backwards. Okay, I think we might be good. Okay, cool. So your DSCR is your property income divided by your debt payments. So let's say that your property is bringing in, to keep it simple, $1,100 a month in income, right? So we got 1,100. And your debt payments, that's going to be your PITI, principal, interest, taxes, insurance, any HOA fees. Let's say your debt payments are $1,000. So what that's going to give you is a ratio of 1.1. What a lender is really looking to see is a ratio of 1 or higher. And that's pretty much going to show that the property has enough income to cover those debt payments. So if you have the higher that ratio, the better. So a 1.2 is typically pretty strong. It can also help you qualify for a lower rate. And so, finding ways to boost cash flow, whether that is, doing some renovations to the property to attract higher paying tenants, or maybe using interest only options to lower your payments while you actually stabilize the property. You can do that as well. But that's the ratio you want to look at when you are looking at qualifying for one of these loans. Now, you can go the opposite way. There are lenders who do, for instance, no ratio loans and loans below ratios of 1, negative cash flow situations. So you just want to be careful of that because obviously they are riskier in that sense. And so they are going to have potentially higher rates. So your DSCR is not the only thing that is actually going to qualify you on these. Your credit score is still a factor. So the higher your credit score, the better. There are lenders that go as low as 575. Typically, most lenders bottom out around 620. So your credit score, even with if you got you can source a down payment because you can use gift funds. Gift funds would, as the name suggests, they are a gift from someone else. So if you can source a down payment, you have decent credit, and the property cash flows, you can typically get a DSCR loan. A lot of people ask about rates. Conventional is typically sitting around, I think, about 7.1 or something like that. With a DSCR loan, you're typically, if you have strong credit, you can typically be maybe a half a point, maybe a little more higher on a DSCR. So I actually priced out one the other day, and it came out to a couple different programs, but they were about mid 7, so like 7.3, 7.5 in that range, and the borrower had strong credit. And so that's one of the scenarios we were working out there, but that is how the credit plays into your DSCR. So these are business purpose loans, which means you couldn't use them for a strategy like house hacking. You would have to be out of the property. And you can't live in the property if you're going to use these because they are business purpose. It's pretty not much I can say on the business purpose thing. So we got covered the formula. Good thing about these, there are no tax returns. You're not looking at W-2 income. Oh, hang on. Isaac, what's going on? Thank you. It does look good. Paper, how you doing? Can you do this with a sub 2? You mean, can you take over a DSCR sub 2? Is that what you're asking? Isaac, can you do a seller carry with DSCR? You can. The Morby method, so that is actually what I'm helping Brandon and Andy with. And so when you're looking at a DSC, for those of you who don't know, Morby method is essentially, this is a bare bones explanation. It's going to be a institutional lender in first position, and then you'll have the seller carry in second position. And so the lender that I'm working with, they actually will do 75% LTV, and then they'll do a 10% seller carry. But the seller carry needs to be structured for 3 years or more. And that's pretty much their only requirements on that one. And then of course you need to come up with the difference for that down payment of whatever's going to be left. So that 15% or so. Okay, cool. More so, can you qualify for a DSCR to use towards the purchase of a subject to deal? No, I don't think you're out on left field. Hmm. To use towards the purchase of a subject to deal. I mean, if you're buying the subject to deal, that the DSCR would essentially be in first position. Um, so it should wipe that out because they'll do up to 80% LTV. I guess depending on how much is left on that person's mortgage when you're taking over those payments. Um, so it depends. I think it is definitely doable. What if the property is not fully occupied and needs work? Can you use DSCR loans? Great question, Isaac. So typically, what most people do is they'll use hard money first, fix it up, and then they will refinance with the DSCR because most of these lenders want to see that the property is in rent-ready condition. Um, so you can start immediately cash flowing on it, and they don't have to worry about um, a property that's going to be in a state of disrepair, and nobody gets in it, and then they're kind of stuck in the water with that if something were to happen and you weren't able to cover the payments. So rent ready condition for DSCR. Almost like a private money lender type thing to cover the entry price, so long as it cash flows and has a great DSCR. Almost like a private money lender. I mean, I guess you could get a PML to cover that down payment. I mean, that's essentially what a gift fund is. Gift fund, excuse me. Um, but you're still going to have some type of reserves because even with gift payments, you're going to have most lenders want you to, if they allow it, most lenders are going to want you to have at least 10% of the funds in your own account to show that you have some skin in the game and you're not just purchasing these properties when you know really don't have the money to support it. Hopefully that answers your question. All right. What were we talking about? No W-2s, no tax returns, great for self-employed, business owners, people with variable income. There is no cap on the amount of DSCR loans you can get. So when you're looking at conventional financing, typically you can get about, I believe it's 10 conventional loans before you are just too risky for lenders to lend to you. But with DSCR loans, you can have as many of them as you want. I was actually at the Aspire event, and one of the speakers mentioned that they had 119 DSCR loans, which is kind of insane. Um, but there's no cap on the limit that you can have. So really cool. Definitely going to help you be able to scale. And you can use these on a wide variety of properties: single family, multifamily, short-term rentals, mixed use. I will say when it comes to short-term rentals, I like to recommend to underwrite the property as a long-term rental first. Short-term rental comps can be a little bit harder for appraisers to find. That was freezing up a little bit there. They don't like that. Let me close some of these tabs out. Maybe that'll help. Janky internet. All right. So, right, short-term rentals, I typically recommend to underwrite as a long-term rental first. And that is because a lot of lenders typically impose a 5% LTV restriction on short-term rentals. just because they are a little bit riskier, because you're going to have, the normal issues that you would have with a long-term rental. So vacancy periods, those random maintenances, fixing up the property, just general upkeep, that sort of thing. But with a short-term rental, you're going to have more off seasons. Tenants are obviously staying for less time, so there's going to be more vacancy. And so overall, there's just more risk in a short-term rental. And so that's why that 5% LTV reduction is in place. It's also harder for appraisers to find short-term comps, much easier to find those long-term ones. And then also, when it comes to short-term rentals, lenders will rely heavily on AirDNA, even if you have the property rented out. So if it's a long-term rental, they typically want to see about 12 months of lease agreements, and then they can use that to qualify you. Unless the market rent is higher, then you could use that. But on a short-term rental, they're going to rely heavily on AirDNA, whatever number it shows on there. And then they're going to be looking at the occupancy rate. And so what they want to see is that occupancy is 60 to 70%. Yeah, that is pretty much the big thing with short-term rentals. So if you choose to go the short-term rental route and you have comps, I would definitely provide those to the appraiser up front, because that can definitely help you out there. And then we got some, mixed use. If the residential portion is greater than the commercial portion, so, at least 50, if you have 51% residential, it'll likely be a good fit for a DSCR. But if it's, the reverse and that commercial side is bigger, then you might want to just get a commercial loan instead, because it might be a better fit. And then DSCRs are typically fixed 30-year loans, but they do come in a lot of different flavors. So they have interest-only options. They have ARMs, so that's adjustable rate mortgages. So for those of you who might not know, when you see an ARM, it's going to look like it's going to look something like that, just for example. And this first number here is just going to tell you, that was an awful sound. The first number here is going to tell you how long your interest rate is fixed. And then this second number here is your adjustment period. So, for instance, fixed for the first 5 years, and then every 6 months it adjusts. And so that's an adjustable rate mortgage. And then they have interest-only options. And so that could look like you have, if you have a 30-year mortgage, DSCR, that could be 10 years interest only, and then it switches over to a fixed interest and amortizes for the rest of that. Or you could have like a 5, some do 15, so it really just depends. You just want to make sure that you're ready when the interest only period ends, that you can actually handle, that you don't overburden yourself when you have to switch back and start paying that principal and the interest. I said these are 30-year fixed, but there are 15s, there are 30s, there are 40s. So it's a lot of different options. It really just depends on what lender you are working with. All right, cool. So moving on to some common myths about DSCR. A lot of people think these loans are only for experienced investors. Now, a lot of lenders do impose restrictions. You can probably guess there might be a 5% LTV restriction depending on the lender that you're using. But you can still get a loan with being a first-time investor. So there are a lot of lenders who do make exceptions. If you want to partner with somebody and leverage their experience, that is a great idea in any scenario, whether you're doing DSCR or not. Leveraging someone with experience who knows what they're doing, because you can also leverage their track record. So that's going to help you qualify for a lot more, even if you're using private money. Most lenders usually specify what they qualify as a first time investor. Um, and so typically what I've seen is a first time investor is someone who hasn't operated a property like a long term rental for 1 year consecutively in the last 3 years. That's a common example of what's the word? Not restriction, um, but just type of requirement that they're looking for to qualify for a seasoned investor, so to speak. So new investors can definitely qualify. High credit scores are mandatory. They are really not. Um, there are lenders who will make exceptions. There are lenders who will work with you no matter what your credit score is. I wouldn't say that actually. I have a lender who goes down as low as 575, but most of them tend to bottom out around 620. Now there are lenders who can make exceptions. You just have to find the right lender who's actually going to work with you for that. We are actually working on an exception on one deal right now to get off of a 5% reduction in LTV. So I'm hoping to hear back from that lender. I need to follow up them tomorrow actually, and see what the dealio is with that. DSCR loans do not include any renovation cost. So typically you will use hard money to fix up the property, and then you'll refinance with a DSCR. But you can also purchase using a DSCR. So if the property is in rent-ready condition, but it's not being rented out currently, property's in rent-ready condition, but it's not being rented out currently, they'll use a market rent analysis to determine, what the market rent could be. Of course, well, the property's not rented out in this case. Yeah, and so with that market rent analysis, they're really just looking at the comps in the area, the similar properties, and they're seeing what those can rent for, and that's how they're gonna. That's what's gonna help determine what your property is gonna rent for. So there's a couple different forms of that, but they're pretty much all the same. So like the 1007 is for single family, and that's like a 1025 for multifamily. But they all include pretty much the same stuff. As you just get higher in units, number of units in the property, they just want a little more info. So like rent rolls and that type of thing. So it's always a good idea to try to opt for a higher DSCR ratio. That's going to be your property income divided by those debt payments. So finding ways to increase your rents or reduce operating expenses, maybe doing some maintenance around the property, making it look pretty, can potentially attract a higher paying tenant. Maybe you can opt for something like solar panels. Do not quote me on that. I've never used solar. I have heard that it works on some properties and that some it doesn't. But yeah, just looking for ways. Maybe you can negotiate property management fees, something like that. So just looking for ways to save cost and boost that number a little bit, so it can help you qualify for a better ratio. And then of course, if the market rents in your area support it, you could potentially qualify for more income. So you want to always stay up to date on that. They will be looking at lease agreements or the form 1007, which is that single family comparable rent schedule. And then of course, as you scale higher, they'll be looking at that 1025, which has literally the same information. They're just now asking for rent rolls, and that's going to be on the multifamily properties. And so those are income documentation that are going to help determine the income for your property. One of the big things to note is reserves. You always want to have some type of reserves on hand. Now, again, pre-varied between lenders, but safe zone, 6 months. I do have lenders with no reserve requirements. I do have lenders with 3 months reserves. But typically, most of those lenders are sitting at 6 months. And then some have, depending on how much you're actually borrowing, you might need more reserves. So that's something you always want to make sure you factor in. Now, a good thing to note is your cash out. In most cases, if you're doing a cash out refinance, for instance, your cash out can count towards your reserve requirement. So that's a good thing to keep in mind. Now, while we're talking about seasoning, seasoning has two meanings, actually. So the first one is going to refer to the length of time that you've owned the property. So that is usually like title to title. So if you got the title in, January, and the lender had a 3-month seasoning period, January, February, March, you could refinance that property if that's what you were looking to do. The other seasoning refers to if you have a down payment and it's sitting in your account. They want to see that down payment has been sitting there, usually for about 60 to 90 days. They want to confirm that this money is actually yours and that you're not borrowing it last minute just for that down payment. All right, cool. Not missing any questions. All right. So finding the right lender. Different lenders obviously going to have different specialties. There are some who specifically focus on, 1 to 4 units. And then there are some that, go from 5 units to 9 units, 5 units to 100 units. There are just a lot of different lenders out there. And so finding the right lender that fits your needs is going to be crucial. There are some who have more lax guidelines when it comes to short-term rentals, or maybe they have better terms when it comes to multifamily. What I have seen, which I do like, is some lenders now are starting to do 85% LTVs. And so I think that'll be really helpful for people getting into properties, especially if you're getting more money on the purchase. Now, when you go to refinance, most lenders are typically going to be around 75%. So just kind of keep that in mind. 80% LTV on a purchase is pretty typical. If you're going to do a rate and term refinance and you're not getting cash out, typically that's also going to be around 80%. I'm thinking of something else. So 80% on a purchase or a rate and term, and 75% on a cash out refi. That's typically what you're going to be working with. So what I was just thinking about was a delayed financing scenario. And when it comes to delayed financing, you can actually purchase a property. If you purchased it cash, and instead of waiting the seasoning period, 3 months, 6 months, whatever the case, you can turn around and go refinance for the amount. You can go refinance based on the amount that you purchased the property for. And so if you purchased the property for $100,000 because you got it at a good discount, and you put a little bit of work into it, now you're wanting to pull some of that equity back out because now you've raised the value. Well, with delayed financing, they will actually only lend on the actual purchase price. and the highest I was able to find for that was 90%. But typically, in most cases, depending on your situation, because it might be different for you, you'll want to use that full ARV, get that full, cash value. You can go plug it into other properties, other investments. Um, and so that just might work a whole lot better for you to get more of your money back out. But that is what I learned about delay financing. Let's see here. Okay, talk about that. Yes. Ton of different lenders out there. Um, if you have, everybody has that one lender that they specifically like to work with, which is great. Nothing against that. But if you're, doing multiple transactions, um, don't be afraid to try out another lender, because you might find a lender with better rates, or terms, or maybe some other option that's going to suit your needs a little bit better. Um, so if you got multiple loans, you never know what kind of lenders you're going to find out there. So it's always good to try new ones. You can still have your specific one, but it's always good to try different stuff, right? So typically, these loans are going to be used with hard money. So a lot of people use them with the BRRRR strategy, buy, rehab, rent, refinance, repeat. The DSCR comes in that refinance portion. We also have hard money lenders at my shop. So they are pretty used to, doing the hard money, refinance the property, and then they'll do your DSCR. Do the hard money, refinance into a DSCR. Let me make that a little clearer. So yeah, that's one way people, investors typically go about acquiring these rentals when they buy properties at a discount, fix them up, refinance with a DSCR if they don't plan to sell. One thing to note on that, though, is if you put a property on market that you just flipped, and for whatever reason it's not selling, or you just change your mind and you're like, I'm gonna, turn this into a long-term rental or whatever. Cool. Most lenders actually do have a seasoning requirement on that, and so from what I have seen, it's going to be about 6 months that you'll have to wait before you can actually put a DSCR loan on it. So that's something you want to be really careful about, because that can screw up your plans if you're not prepared. There are lenders who do blanket loans. And so, as the name suggests, you're putting multiple properties under one blanket. And so what that can do is it can, if you have loans here, 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 it can consolidate all that, make things a little bit easier for you on that end. But the main benefit is it can actually boost your borrowing power, because now you have all these assets coming together, and you're able to leverage the equity in all of those. Just make sure you have a plan, because now if something were to happen and you defaulted, now all of your properties are at risk. And then if you were to go and sell a property, you might have to check with your lender to make sure you can pull it out of that blanket loan, to sell it, refinance it, whatever you were choosing to do with it. So that is blanket loans. Short-term rentals use AirDNA for income projections. Covered that a little bit. They heavily rely on that, and they're looking to see that 60 to 70% occupancy. And then they're looking at that market rent to see what it can rent for, even if your property's already rented out. They're still going to be looking at that AirDNA number, so it's super important. Great loan to refinance to after house hacking, a DSCR. So what I learned is, so house hacking is a strategy where you live in one unit and you rent out the other units, right? And so typically, you could use an FHA loan or a VA loan. Thank you, veterans, for your service. Use one of those loans, get into the property, rent out the other rooms, do your thing. If you do it right, you could be living rent-free or pretty freaking close to it. With that being said, those loans actually require you to live in the property for a specified amount of time, typically a year. So with that, if you wanted to, maybe start another house hack, or it was time to move on, whatever the case may be. You get to a point where you want to refinance. If you refinance using an FHA loan, or if you refinance using another VA loan, you'll have to stay in the property for another year because that's actually one of the requirements of the refinance. So this is where DSCR or using a bank statement can be a great option for you, because again, it allows you to refinance out of that without having that restriction of staying in the property. And so that can really be helpful if you're trying to get out of that and move on to your next investment. So yeah, talked about the hard money loans, fix and flip scenarios, hard money, refinance with that DSCR using the BRRRR method on this. You could also use 1031 exchange proceeds to cover the down payment. So there's an option for that. And then these properties are also great for things like Section 8, assisted living. Those qualify as long-term rentals under the DSCR guidelines. I do have a lender who is doing pad splits. So if you have any questions on that, or if you have a scenario, that would definitely be something I would love to talk about, because I would love to put something together and figure out how we can get some pad splits rolling, because it's becoming increasingly popular. Similar to the SRO strategy, the rent by the room. So yeah. Let's see. I think I feel like I pretty much covered everything. So I will hang around a little bit if anybody has any questions. But other than that, it's date night. I don't know what we're gonna do yet, but we're gonna figure it out. And I see, since I'll have to set that up to make that available, actually. I'm not going to tell anybody to do that now, because I did put together a little guide to help people through the Marby method, just a basic breakdown, basic understanding of what you can do. So I will be working on rolling that out here shortly, if that is what you guys are looking for. But if you actually go over to my Instagram and you DM me the word guide, you can actually get a basic kind of starter DSCR guide. And yeah, I'll be rolling out some more freebies like that, just to kind of educate people, and keep the education train rolling. So I'll hang out here for a couple minutes. We're at 43 minutes. Of course, I did spend some of that setting things up, but pretty good, pretty good. I am pretty excited to announce the first episode of the podcast. It's going to be imperfect, but it's going to be awesome. I'm super excited. The first guest, I believe, is also just as excited as I am. So I'm grateful to those who are taking the opportunity to come on the podcast. And, even though I don't have the most pristine setup, I'm glad they're giving me the opportunity to talk to them, to learn from them. And I hope to bring you guys some very awesome stories. So very awesome stories, very awesome speakers. If you have anybody, the whole point of this is for us to all learn from each other's mistakes, learn from each other's experiences. So we'll be interviewing self-employed borrowers, business owners, real estate investors. If you got a story to tell and a great experience to share, love to have you on. Definitely, Instagram, best way to reach me. Or you can reach out to me at 919-889-3362. Please don't just send me a random text not introducing yourself, because that's just not the way to do it. So yeah. Oh boy. Well, cool. Nobody has questions. That means I did a bang up job uh, explaining DSCR loans. So, without further ado, I will be signing off. Y'all have a good night, and I will see y'all back here tomorrow at 7 p.m. Peace.